The federal government almost made it a clean sweep on the Murray report, announcing it's accepting 30 of the 31 recommendations made by the Financial System Inquiry. It's being interpreted as a big sign that the Turnbull government is determined to make the financial system safer. Despite that, a recommendation to ban borrowing by self-managed superannuation funds was rejected. And with the spectre of rising rates in a cooling property market, there are fears super borrowers could be left dangerously exposed. Andrew Robertson reports.
Graham Bottrell is one of the 1 million Australians in a self-managed superannuation fund. He's also a member of the Australian Investors Association, and like the Financial System Inquiry, he has big reservations about superannuation funds borrowing.
I just worry that people will go into that without considering all the pitfalls and the traps and without adequate advice and get themselves into trouble.
Since the Howard government allowed superannuation funds to borrow again in 2007, self-managed funds have racked up loans against property worth $14 billion, evenly split between commercial and residential. That's out of a total of $88 billion of property held by self-managed funds.
If the property value is 60% borrowed, then that's okay. But if it's 100% or even a little bit more than 100% to cover the legal and other costs associated with borrowing, then that's highly risky.
Unfortunately, the Tax Office, which regulates self-managed superannuation funds, doesn't release figures on borrowing against individual properties, which Claire Mackay thinks is a big weakness.
We need to be confident about the risks people are taking with their retirement savings. And at the moment, we don't have a clear understanding of the true risk in the system.
It's one reason why the man who chaired the Financial System Inquiry remains adamant that borrowing by superannuation funds should not be allowed.
Leverage magnifies risk on the upside and downside, and therefore it's not appropriate to add that other layer of risk also in the superannuation sector.
And two big risks facing leveraged superannuation funds are that record low interest rates will rise and that the overheated property market will fall. While David Murray is disappointed with the government's rejection of his recommendation on borrowing, he remains encouraged by its plans to closely monitor that decision over the next 3 years.
Our view about direct borrowing in superannuation funds across the superannuation system was about risk and systemic concerns, so it wasn't specifically targeted at self-managed funds.
But it's self-managed superannuation where debt is the biggest issue, particularly with spruikers out in force encouraging people into property, often at inflated prices with very high commissions. 2 years ago, we highlighted New South Wales-based Park Trent Properties, which has advised nearly 900 people to set up super funds to buy home units and townhouses. Back then, Park Trent boss Ronald Cross strongly defended his position.
We're an icon. We do a great deal for Australians, and to call us anything other than a business enterprise, I think that's a cheap shot.
Not according to the Supreme Court of New South Wales. On the day the government released its response to the Financial System Inquiry, the court put a stop to Park Trent's business because it had been giving advice without holding a financial services licence.
We need to make sure that anybody who is providing that kind of advice is actually forwarded on to the appropriate regulator, such as ASIC, and then ASIC can deal with them.
Having said that, though, Andrea Slattery thinks the government was right not to ban borrowing by super funds.
It's so small, and that if it's controlled with the appropriate guidelines and the appropriate licensing arrangements, then people should be able to get the appropriate advice if it's in the best interests of that client.
As he enjoys his hobbies in retirement, Graham Bottrell says the bottom line is retirees have to protect themselves.
You need to get some education and work out how you're actually going to do that for the next 20 or 30 years.
The alternative is your retirement running right off the rails.